Now, a lot of traders come across this during their trading experience, trading journey. You've placed some trades, you've gone to sleep, woken up, they've closed out, you've had stop losses in, you're risk managing, but your stop loss did not get filled to the pip that you requested. This happens on more occasions than you can imagine, and it's a market phenomena called slippage. Now, why does slippage occur? Well, it's nothing really to be too concerned on. In fact, it should give you a bit of comfort because you're actually trading in an environment that's putting you into the underlying market liquidity, or the ECN, which combines thousands and thousands of market makers all participating to bid on the prices that you've tried to exit at or take your profit at. Now, slippage could occur during the times of market volatility, for example, news events that occur in the market, which could increase volatility, and as a result, you experience slippage. Also, another key reason behind market slippage, or another method behind it, what's pointed towards it, is periods of low liquidity or low volatility. Now, low liquidity leads on to the second key point for why your stop loss or take profit could not have got filled at your requested price, and that is the spread. Right? It all runs in sync together because the spread essentially is the price that you're going to get filled at. You need to really account for this within your trades and your risk management to account for periods of low liquidity or news events when you're trading, and account for a possible wider spread than you're used to seeing. And that could be one of the reasons that your stop loss or take profit does not get filled at your requested price. Remember, these are never actually guaranteed in an ECN because somebody is actually on the other side bidding on these prices, and if there's low liquidity, or if there is a news event, a highly volatile market event, you may not actually get someone to take that other end of your trade in the market. So the spread is what you should be mainly concerned with, because that will show you exactly where you will get filled at. If you're buying, you're looking at your bid. If you're selling, you're looking at your ask. It's important to have the ask line on your chart at all times to have a look at how your spread is deviating, and that is your actual trade fill level in respect to your entry also. Let's go through an example, a basic example, to help you kind of understand how market slippage occurs and how it could possibly affect your account. In addition to that, how you could best risk manage around these events. So let's draw a basic chart here, right? This is the Euro US dollar. And you've chosen to sell the market at 1.12345. That's your sell price. Right? You have a stop loss inputted above that, 10 pips higher, 1.12445. And this is the stop loss that you've entered in as the trade's been ticking along. Now, what you're seeing is the market move, operate below your stop loss, so you're still in the trade, you're in the money, and then boom, you get closed out. The price you get closed out at is actually not at 1.12445, but the actual price you get closed at is at 1.12545. So this is your fill price on your exit, and it's 10 points worse off. Rather 10 pips worse off than your actual desired stop loss. So you've been taken out at the market at 1.12545. In relation to your trade size, that could have been $100 loss, a $10 loss, or a $1 loss with regards to the actual loss from this slippage. So this could have happened, for example, at a period of news or where spreads were generally pretty high due to the third and final point we're going to touch on, and that is settlement time. Now, what is settlement time and when does it occur? Well, it occurs at 0000 GMT plus 2 with respect to daylight savings. Settlement time at this particular time, the FX markets close for a period of 5 minutes. This is the time where banks get together, they settle their FX transactions at that particular price. In London, they do it mainly for Europe, a lot of the clearing, New York for the US. Settlement in FX tends to widen spreads around that time for about 5 minutes. So when you are trading overnight, holding positions overnight, do account for possible slippage during settlement, as spreads tend to be slightly wider. Now, again, like I said at the beginning of the video, this is a market phenomena. It does happen when you trade in the real market, so it is something to be expected, especially during news events such as NFP, for example, where 10 or 15 pip euro dollar spreads are pretty well expected or seen in the market during times of news. So do consider all of this when you do trade in your risk management. As always, like, comment, subscribe below for more great videos. We will keep producing great content like this, and as always, trade safer. Any questions, let us know.